afternoon, everyone. Thank you for joining us for Coffee with Carl. Today, Carl will be joined by David Schassler, Head of Multi-Asset Solutions at VanEck. David brings a data-driven, analytical perspective on markets, asset allocation, and multi-asset strategy. His experience managing model portfolios and evaluating global trends will offer valuable context for the year ahead during today's discussion. So thank you for joining us, David.
Thank you so much.
Thanks, David. Appreciate the time today. So welcome everybody. As Mary mentioned, another installment of Coffee with Carl. Today we want to have David and his team, just give us a highlight of, where they see the opportunities in the market, where they're really attacking. They certainly have an expertise in the thematic investment space. So I wanted to go ahead and turn it over to you, David. Maybe just give a quick introduction of yourself and of the firm, and then some of the strategies you help to maintain.
Great. And Carl, can I share a presentation?
Yes, you may, please.
Awesome. So I'm going to share a deck, and this deck has some of the most important pictures I think we could show given where we are right now in the cycle. So I'll start with an intro. Just talk about the firm for a second. So VanEck is, I would say, a mid-sized asset manager. It's hard to tell where we are in assets, maybe $170 billion as of today. There's a lot of volatility in the markets. But here's the important part. And this is a timeline of the firm's history. We've been around since 1955. I view the firm as one of the original thematic shops, thematic investors. Now, what do I mean by themes? If you think about market cycles, historical market cycles are really shaped by investment themes. And if you miss a theme during any market cycle, you leave a lot of money on the table. And that's always been the case. So back to the firm's origins, the firm really hit it big and gained notoriety during the inflation of the 1970s. In the 1970s, it's all about assets with embedded scarcity because those are the assets that benefit during periods of inflation. Fast forward to the 1980s, 1980s is all about globalization. 1990s was about technology with the introduction of the internet. Then we got to the early 2000s, that was about securitization. No matter where you bought your house, it went up a lot in value and people made a lot of money. Then you got into the early 2010s, we got back into technology. So as we sit here now, I'm going to move this slide around a little bit. I'm going to talk about our current themes. I don't care how old you are. The themes that we're faced right now are the most impactful, we believe, that you're ever going to experience and that anybody's ever experienced before. It's not the themes individually, but it's the collision of the themes that we have. So now I'm going to be a little bit more specific. The three biggest themes that are shaping markets as we sit here now. The first is transformative innovation. We're talking about AI, of course. AI is a general purpose technology. It's literally going to change the world. From our perspective, AI is not overhyped. In fact, if I was going to pick a side, I would say it was underhyped. We're going to get to that. The second, old world assets need to build new world. So if you think about the world we're quickly moving towards, it's a digital world. Yep. It's a world that benefits from AI, innovation, productivity gains from the combination of AI combining with robotics and automation. That all happens off the back of old world assets. Lots of picks and shovels, lots of old world assets, dirt moving, resources, etc. There's quietly a stealth bull market happening right now in old world assets. We're going to get to that as well. And then lastly, who's going to pick up the bill? In this country, and this is not just a US thing, but certainly a problem here in the United States, we've been structurally overspending for decades. The idea that spending doesn't matter, debt doesn't matter, deficits don't matter, that's nonsense, right? We're in a period where debt does matter, spending does matter. And that's why you're seeing gold rally the way it is. So who's going to pick up the bill for all this perpetual excess spending? It's going to come from the form of debasement, and you need to have protection against that. So that's the whole setup for today. So when you look at this slide in front of you, it says the illusion of financial restraint is over. And I call it the illusion because we're going to stop pretending, and then we're going to talk about that a little bit. Our argument is we've been pretending. We've been perpetually overspending, but talking about fiscal austerity and Doge and all these little things. What we're saying is that we're moving very, very quickly towards a tech race. And in that tech race, losing is existential. It'll be very similar to like World War II or during COVID, where people weren't talking about how we're going to pay for it. They're just talking about we can't lose. And when you adopt that wartime mentality, debt becomes less relevant, and losing is all that matters, and winning at all costs. And that's clearly where we're moving to very, very quickly. The big, beautiful bill will be the appetizer for many more spending bills to make us effective and competitive in the new world. And all of that requires significant more resource assets, commodities, natural resource infrastructure, et cetera, all paid for with debasement. So that's the setup for today. Now let's jump right into it. So what we're seeing right here is the debt in the United States. The dark blue line is the actual level of debt. That comes from Fred. Now, what that's showing is that we've been perpetually overspending. Now you've got CBO. The CBO makes estimates, and they make estimates out going about 10 years out. So they're saying in 2035 that the total public debt for the US will be $59 trillion. We're saying that doesn't happen. We're saying it's going to be significantly higher because that baseline is based off of fiction. They assume no recessions, no crisis, and no impending tech and industrial race. So if you just start to make reasonable assumptions to that, you get to numbers like $70 trillion really easily. And I could see a number being 80, 85 trillion, and we're going to get to all that. Bottom line is that debasement's here because someone's got to pay for all this perpetual overspending and the ambitions of the future. So what we say is you use debasement as a tool to pay for the sins of the past, perpetual overspending, and the ambitions of the future, because you must be competitive in the new world that we're moving to. It's going to be very, very expensive. This is an alternative way to think about asset prices in the old regime. So there's this idea, and we say this tagline over and over and over again, which is we're not going back. And when I say that, what exactly am I saying? There's the old regime. The old regime was about price stability, assets appreciated in both dollar terms and gold terms. Why am I referencing gold now? Gold is the ultimate store of value asset. It's the ultimate measure of account. It's survived every monetary experiment in history. So it's not just a commodity. It's the ultimate store of value asset. It's the ultimate medium of exchange. It's honest. It can't be manipulated the way the dollar can be manipulated. So if I start to measure asset prices in units of scarcity, i.e. units of gold, it completely changes the picture. So what you're seeing here on the left is, in the gray, is the SP 500 index. You've made a lot of money in the SP 500. But if I invert that and I compare it to the price of gold and I measure it in units of gold as opposed to units of dollars, well, those returns maybe not be as robust as one thought. Your home price up a ton, but is it really in units of scarcity, or are you looking at a weaker dollar? The same thing for bonds. You eked out a return, but in units of gold, not so much. All we're saying really simply is this. There's no scenario where Dorothy clicks her heels together 3 times and you wake up in a world where debt doesn't matter, deficits don't matter. We're in a period of accountability. And in a period of accountability, units, the measuring stick changes, scarcity is valued, and it's an alternative way to look at the world. So the government shutdown was a big thing. Obviously, that's over. But the reason why I kept this in the presentation is really simple. It's a symptom of a major issue. And that major issue is a system not working for the majority. When you end up with inflation and debasement pressures, what happens is you put a tremendous amount of stress on a system. The divide between the haves and the have-nots continues to widen. The haves, those with the money right now, are continuing to drive the economy, where most people are sitting this out and struggling day to day. They're struggling with declining purchasing power, and quality of life for the majority of Americans is dwindling, while some are excelling in this regime. When it gets bad enough, people say enough's enough. In modern times, they express that view at the ballot. In previous periods, it would be violent. But the bottom line here is really simple. When the system doesn't work for the majority, but it only works for the minority, the majority revolts. And that's when you get a rise of dysfunction in government. You get a rise of populism and socialism in places like New York City, which was the center and the heart of capitalism with Mr. Mandami. You're getting more progressive candidates win because people are saying, and rightfully so, the system's not working for me and I want mine. And that's a stress. We just got through Thanksgiving, and we all know that we've got relatives we can't bring up politics with because it'll end up with a turkey going across the room. That's a symptom of pressure on a system that relates to and unfortunately ends up in a situation where you've got tribal behavior. So unfortunately, this gets worse, not better, as we continue to deal with these pressures. So gold, the ultimate store of value asset. So I keep talking about gold, not because we're absolutely in love with gold. We're talking about gold because when I reach into my toolbox as an investor, I say to myself, what's the problems I'm dealing with? And what's the best tool to pull out of the toolbox to help me deal with those issues? I said it before, I'll say it again. Gold's been the ultimate store of value asset. It's out-survived every monetary experiment ever. And it's going to continue to be here well past the dollar. Now we're not calling for a structural decline in the dollar. We're just saying that the dollar is going to buy you less and less in the future as we continue to debase. When I say debase, we're going to create money out of thin air to pay for all this debt. Now, that sounds horrific on the surface, but if you think about really what I'm saying is that if you've got a system with a ton of debt, and that we showed you the debt before, if I could pay back yesterday's debts with dollars that are worth less today, it makes the debt problem a lot more manageable. So we're saying that it's actually the solution to the problem because it allows us to run a little bit harder than desired to solve a very, very major issue that we perpetually overspent for an extended period of time. And there's no reasonable path towards austerity and belt tightening at this point that's going to get us back to where we want to without a huge recession. So we don't think that happens. So let's take that off the table.
So is it, I mean, you guys are projecting more of just growing our way out of it.
Yeah, it's exactly that. You're going to take, and we're going to get into the technology piece in a second, but it's going to be a two-pronged approach. The first is that AI is going to drive massive productivity. It's going to drive economic growth. At the same time, we're going to run hotter than historically desired, and that's going to make our debts more manageable. And you're going to soft land on this. You're going to end up in a really good spot. And here's the thing with this whole presentation. We're presenting problems, but every time I suggest a problem, I'm also providing a way to make money off it. So what I'm saying really simply is that play your cards right and run your asset allocation the right way, given all the variables that we have, you end up making a lot of money. That's really kind of the simplicity of this presentation. What this is showing, and I've got to update this now, because when I update this now, what you're going to see this blue line right here? That's the rolling price of gold. And what it's saying is this: because of all the issues that I described already, gold is the top performing asset over the 1 year, the 2 year, the 3 year, the 4 year. And it doesn't show it here, but it is the case now, the 5 year period. It's not an accident. Not an accident. It's not an accident that we woke up one day and the hottest selling item at Costco was gold bullion. Not an accident. It's a natural, instinctual reaction to a system being stressed and people saying to themselves, hold on a second. Everything I was told was wrong. I want to protect myself. I want to protect my clients and my family. And I want to own assets with embedded scarcity. We think gold goes a lot higher. We introduced a price target to gold in the beginning of 2025 this year. And we said that we think gold hits $5,000 sometime in 2026. We still think that that's right.
How are you guys thinking about, and you may get to this, but from an asset allocation standpoint, because that's one of the bigger questions, are we thinking this as this concern of inflation and overspend comes into the mix? You thinking like 3%, 5%, 10%, and you may get to this, but I, want to put that question at the most basic level to you.
Yeah, we're going to get there, but here's the thing. I'll give you a peek behind the curtain. 5% to gold bullion for most investors sounds about right. That sounds about right. We're not talking about 20%. We're not talking about 30%, right? We're talking about 5%. It's enough to provide the stability in the portfolio that it was designed for. And here's a very different asset. Now, I'm not trying to convince anybody to buy Bitcoin. We're going to talk about Bitcoin for a second. Bitcoin we view as gold 2.0. This is like a third rail, and it's a tough part of the conversation because it's a polarizing subject. But we view Bitcoin as an alternative to gold. It has the same scarcity benefits because there's only a certain amount of Bitcoin that can ever be mined, just like there's only a certain amount of gold that can be mined. So it has embedded scarcity, but it also has the ability to be transferred, stored. So it also has the same store value assets characteristics as gold. But here's the thing. We're moving very, very rapidly towards a digital world. So this is an asset that fits very cleanly into the world we're obviously going into. This asset continues to be institutionalized, meaning that more and more big firms are adopting it and accepting it. So we think that this is here to stay. The ship already sailed as it relates to our digital assets here to stay. We think that's already been answered. For us, the answer is not 0% in a portfolio. We think if your number is 0, consider 1%, but we're not here to try to convert people into doing this. We're just offering it as another idea for people to diversify. And here's the thing. A lot of people can't own it, right? There's a lot of people that can't custody it. There's a lot of firms that don't allow it, but we're just offering out there as an idea. If the number is 0, consider it at 1%. Let's get
Yeah, I
back.
think they had Morgan Stanley, I think recently, or one of the big investment banks came out with a target of like 3% with as how they look at their asset allocation into the future. Do you guys have a ideal number? Same thing with like gold. Did you guys think about? Again, risk levels obviously always adjust this, but like an all equity portfolio, for example.
An all equity portfolio would be higher. For a moderate investor, we're going to be 2 to 3%. Right now, we're about 2.5%. We've been buying the dips because Bitcoin is now more attractively priced now than it was certainly 3 months ago. So between the 2 to 3% range, depending on where it is in its volatility cycle. But yeah, that's for the average investor. If you're an all equity investor, that number is going to be closer to 5. So we could see you for a very aggressive investor being up to 5% will be totally reasonable. And that's how we run some of our more aggressive solutions. Let's talk about reshoring for a second. The US woke up one day with basically a 30-year hangover and said, hold on, maybe we did too much. Maybe the idea of offshoring all of our industrial capacity to China was probably a step too far. So reshoring, what is it? We're talking about breaking apart globalization. What's globalization? Globalization is a global network of extreme cooperation to drive the price of goods and services lower. That's what it is. It's extreme cooperation to drive extreme efficiencies. And now we're going to break it apart. And then we're going to pretend like that's not going to be expensive. That's insane. Yeah. So what we're saying here really simply is that reshoring builds what already exists abroad, but it's going to do it 10 or 15 years from now at a price significantly higher. That's the setup. Sorry, but that's where we ended up, right? That it is what it is. So we're trading cheap imports for expensive independence out of necessity. It's backward-looking industrial policy at best. And resilience comes with a productivity tax. So it's the play you have to make now, given where we are. Get that. But let's not pretend like that's not going to be inflationary. It is. And when it reshores, there's a lot of that productivity is going to come from robots. And we're going to get into that as well. So here we are. Bring out the robots. Debt meets transformative innovation. So now we're going to segue a little bit. Now let's talk about growth. Let's talk about optimism. Let's talk about the weird world that we're moving into very, very quick. Let me start with a comment I made earlier. AI is not overhyped. If you start to think about the scale and scope, the speed at which it will transform the economy in the world, it is underhyped. The internet made a lot of big promises, completely over-delivered. The world is nothing like what it was in 1995. It is nothing like it was. But because it happened, most of that transition happened over a 15-year window. We were dripped on every day. So it felt like the change wasn't radical. In fact, it actually was. You can watch those documentaries, somebody coming out of prison and now walk into the new world and they're shocked at what they're walking into. That's what happened. But because we got the changes in very, very little increments over time, over a 15-year window, it all seems normal. So let's talk about innovation and productivity and the way things are going. AI is a general purpose technology. Other examples of general purpose technology: wheel, steam engine, electricity, computer, internet. These are the big ones. These are the big ones. What do they have in common? Post introduction of a general purpose technology, nothing's ever the same. And now I just gave you a few examples of general purpose technologies, but here's the key. It's the rate of change. There was over 5,000 years between the wheel and electricity, but there was less than 100 years between electricity and the computer. A shorter gap between the computer and the internet. We sit here now, we're seeing major breakthroughs in AI every 2 months. Those that are closest to it continue to be shocked by it. So I'm a huge hockey fan. My team is terrible, the Rangers, but huge hockey fan. So there's an expression used to describe this type of growth. It's called the hockey stick pattern, because it goes like this and then it goes up. And that's where we are. So when I'm telling you things are going to get weird, they're going to get weird. And it's going to happen fast. Those that are closest to it are not debating about where we're going. They're only debating about how fast we get there. And the conversation is somewhere between 5 and 10 years. 10 years on the longest. But most people are in 5 to 7. So let's talk about what it is that we're talking about. Let's be really specific about this. So the first part that we go to is kind of self-preservation as individuals. And this is where I spend a lot of my time talking about, well, how does human beings engage and work with robotics? Now, AI adoption correlates with reduced hiring needs. So if the machine could do the job right now, it's starting to do it. And employers are being more selective about who they hire. That's why you're seeing really high unemployment rates for recent college graduates, because these are typically people that sit behind screens and push buttons. Those are the people that are really easy for AI to start doing the same job. If you don't talk to anybody all day and you do repetitive tasks, push buttons, put your head down, you grind out your day, you should broaden out your tool set, because AI can do that. If AI can do what you can do without you, and it's that automation of that, that's a problem. So human beings have to look at that and say, how do I use this technology as an accelerator? So it doesn't replace me, but it accelerates me. So what you're seeing now is where the computer can do it, it's starting to. Computers, people that work behind computers, math, management, anywhere up in the right, you're seeing a direct impact on hiring. But here's the interesting thing. A lot of times people say, hold on a second. Well, that's why it's good to go into the trades. And I agree. We need people in the trades without a doubt, right? The world, the US in particular, would benefit from people going to trade school. So I'm not going to debate that. But here's the thing. I'm also not going to pretend like those jobs aren't going to be impacted. It's just going to be later down the cycle. Once the brain, which is AI, combines with the body, which is robotics, those two together are going to drive extreme innovation across the entire labor force. Yep. Don't tell me if a Tesla or a Waymo can drive me. I'm right now in New York City. I live in Westchester County. Don't tell me if a full self-driving Tesla or a Waymo could pick me up downstairs and drive me across the entire city and all the way up to my house an hour away from here, 4 times safer than a human being can, then a lawnmower can't push itself across my yard. That's nonsense. That's nonsense. The reality is that once these robots, which look and operate very similar to human being, complete dexterity, the hands are very basically the same as ours. They're made to fit within our world. They're going to be able to do most of these household tasks. They're going to be able to drive innovation across the labor force. That's when things get a little weird. So 2 of the largest employers in the country are Walmart and Amazon. Doug McMillon from Walmart. It's very clear that AI is going to literally change every job. Andy Jassy. In the next few years, we expect that AI will reduce our total corporate workforce. Now, here's the thing. This is becoming a PR issue. This is becoming a PR issue because at first they were saying, oh, this is going to happen. And then when it actually started happening, it was getting pushed back. So you're starting to kind of see internal memos leak out. But here's the path. AI, Amazon came out and reported, and they're benefiting from the adoption of AI. So the market likes that. They announced 30,000 layoffs, 15,000 immediately, but these are white collar jobs, HR, middle level management. But here was the interesting part. They're talking about this Blue Jay robotic arm. Now, what that allows them to do is change from these huge mega factories to these more regional hubs and use this robotic arm to complete orders. They're working constantly. There's no downtime. There's small regional hubs. You have the second biggest employer in this country give you a blueprint on how to drive automation and efficiency from their front office all the way to the warehouse. Pay attention.
Yeah, how do you, one of the questions I constantly have is how do you deal with that, right? And the pushback that you're going to get politically. Because I think that's the biggest challenge with AI, right? Is as you get this automation, a lot of these jobs have to be replaced, right? And then you're going to have, you're having a lot more progressive candidates coming into the fold. How are you guys thinking about, does that create a slowdown with some of the automation just politically?
Here's the thing. We're in a global race, and our competition doesn't play by that playbook.
Correct, right? Yeah.
So my biggest concern here is that we lose the race because we decide to lose the race because of exactly what you described. It's not because the ability of the American worker or the innovation of the American worker to be able to compete against China. That's not the issue. Is life so good in this country that we're going to lose a competitive foothold for protectionist policies? If you don't have growth, there's nothing to protect. Let's just be clear about that. Yep. So any misguided kind of attempts to protect things that don't fit in the new world we're moving to just slow us down and put us in a situation where we're going to be a lot worse off in the future if we can't compete. Because if there's no growth, we're not going to have anything to protect. And that's where people have to get their minds around. So it's the same thing. Listen,
Do you think they can? Because you think about it, you look at some of these shipping ports, right? Where you have unions that basically don't allow a certain level of machines, right? I mean, you remove them from the equation, you have lower costs across the board.
there's a lot of relics of the old world and they've got footings, but they're going to be moved around. At the end of the day, when faced this, I can give you a lot of examples of this, but nuclear would have been the latest example. So I grew up in the Hudson Valley overlooking Indian Point, which is a nuclear reactor. The nuclear reactor was shut down in favor of burning fossil fuels. And basically, the political activists decided that it was a good idea to shut down this energy source, which is durable, sustainable, cost efficient, and had no carbon footprint, right? And then we started getting higher energy prices. And the same folks that were standing in front of these reactors screaming, shut them down now, let's save the planet, right? And singing Kumbaya together, are now the same folks standing in front saying, turn it back on. Because that's what happens. And automatically it became a bipartisan issue and a global issue. And that's what happens when you overcorrect. So the biggest concern here would be that we get in our own way and we slow down the race. And that doesn't mean that regulation isn't warranted, and it doesn't mean that you don't have to have a sensible path forward. That's definitely not what I'm saying. But what I'm saying is you can't get in such gridlock and such protectionist policies that you fail to embrace the technology that's clearly here for the future, while your competitors are, and then sit around wondering why you're not doing well. So what you flagged was the biggest risk to AI, and I'm glad that you flagged it. So thank you.
Yeah, I mean, it seems to me that's the biggest bear case, right? Other than that, I don't know where you argue that you're not going to get expansion with AI, robotics, or any of these themes.
Yeah. Here's one more apologies to anybody that works for Accenture, but they're laying off 11,000 staff. They announced it only as a consultant could and called it an AI reskilling strategy. So kudos to them for creating a very, very cute way of telling people they're not going to have jobs. Here's the thing. What does Accenture do? Accenture does what AI does, it just does it for more expensive. They figure out ways to drive automation, scale, and efficiencies across businesses. They basically do what AI does, they just don't do it as well. Things are going to get rough for these guys. 3 ways of AI economic impact. So this is the way it hits. Now I'm talking about it from an economic perspective. Phase 1 was build. This is still where we are, but we're moving towards phase 2. So, and let me give you a disclaimer on this before I go any further. Not every company is at the same part of the cycle. Like Tesla is already in phase 3, and many segments within China are already there as well. But most of the world's still in phase 1. So what we're saying is we're giving you a framework on how to think about AI and think about the evolution, how it's going to fit. And then you could take that back and think about how do you play it from an investor's perspective and what to anticipate as a human being living this experience. So phase 1's the build. Spending is up. We're spending more money. Listen, we're spending billions of dollars on CapEx investment in technology. At the same time, right, human beings are competing directly with AI. And we're losing because the money is going out the door. It's going into tech investments. It's not going to human capital. It's going to technology investments. On the ground, the situation is largely unchanged, except for we're spending more money. So headcount's largely unchanged. There's not a huge impact in productivity. There's not an ROI. There's not a return on that investment. At this phase, it's just a lot of building. We're building compute, infrastructure, energy sources. We're going to get to energy more in a minute. I spoke a little bit about nuclear. We're going to get back to that. But that's where the scarcities are in the build out right now. So anything associated with building, creating AI, those stocks are up a ton. That's what's pulling the market up. And now we're moving very, very quickly to phase 2. And we're obviously seeing signs that we're in phase 2. Anytime a company comes out and announces billions of dollars being spent on AI without a credible repayment path, stock market doesn't like that. Stock market does like, this is how we're using this technology to drive efficiency. Love that. Hate the first one. That's where we're at. This is when things start to get real. Output per employee increases. Marginal labor costs decrease. Margins improve, not huge. You're just starting to see the adoption of the technology. Now let's talk about phase three. Phase three, everything changes. Nothing goes back. Nothing will ever be the same. Robotics. AI, the brain, combines with the body, which is robotics, to drive mass productivity, mass efficiencies, and growth. Now, margin cost down, units per hour up. These things don't go to sleep. They just keep pumping. Elon Musk said something the other day. I was listening to a podcast. Robots may run out of things for to make for their humans. That's what type of productivity we're talking about. We're talking mass productivity booms. These things don't go to bed at 5 o'clock. They don't leave work at 5 o'clock. They just keep pumping and pumping and pumping. That's where we're going. And now think about this. I know it maybe scared people before when I showed how it impacts human labor. It just changes the game. Longer lifespans, higher quality of lives, more leisure time, more time with family. Not too bad. That's what I'm talking about. That's what we're talking about. We're talking about high quality healthcare. You don't have to find the best surgeon because the technology is going to provide the same high level of care to you, regardless where you sit on the economic spectrum. That's what we're talking about, right? We're not talking about some scenario where everybody's on the breadline for the rest of their lives. UBI across the board, universal basic income. We're obsolete technology. We don't fit. We're talking about significant improvements in the quality and duration of lifespans. That's the goal here. That's the hope. That's clearly, in our opinion, where we're going. Let's talk about power for a second. It's kind of a political hot button. I'll touch it. Fine. One of the cruelest things ever done to people that are struggling financially is ideas like green at any cost. Ideas like, I feel like this is better, so let's do that. Let's not even look at how much it costs. Let's just do it. Because what you're doing is you're setting up a scenario. It wasn't by design, but it's the result. And we got to think about results. When you live in a country with a very, very high quality of life, it's easy to invent problems, right? And that's largely where we fell into. So we started pursuing hyper aggressively wind, solar, and other forms of intermittent energy. So we're not opposed to that by any means. But what we are opposed to is the vilification of any energy source. We are opposed to writing checks without checking in your account to see if that check is going to clear. We're vehemently opposed to that. So our view is really, really simple. The science has to meet the reality, and it has to make economic sense. So what does that mean? That means you use what you have now, which is fossil fuels. You lean into what's here, proven, reliable, sustainable, and durable, which is nuclear energy. It should never have been vilified, but it was. It's clearly part of the future, and we're moving very, very quickly. Who doesn't want safe energy that can be mass produced, right? That's the setup. And the fear didn't match the reality. Now, when it goes wrong, it's clearly not good, but regulation fits in there as well. But that's where we're moving towards. And here's the thing. Hope for and expect innovation as it relates to battery technology and everything else that's going to make wind and solar more valuable. As it's more viable, of course you want to use it. All we're saying is we got a little ahead of ourselves. And that was a very costly mistake because we gave up our footing in other places. So the world we're moving into, the base case estimate is that electricity demand is expected to double by 2050. Not just because the technology requires a lot more energy, and it does. But if you're sitting in an emerging market and it's hot outside, you're going to want air conditioning on your skin. And when you look at your plate, you're going to want to see a protein. So as emerging markets adopt the more American lifestyle, you're going to expect that they're going to require more energy. So the world's moving towards more energy, and we need to meet those demands. And the bull market, this is what I call the stealth bull market, which is real assets. Everything that I described, nothing happens without old world assets. The old world builds the new world. Whether I spoke about reshoring, whether I talk about AI, whether I talk about robotics, all of that requires significant onshore, significant real world assets. So as we sit here today, a lot of people are surprised to know they know tech stocks are up a ton, but they don't realize that a lot of resource assets, including natural resource equities, are actually outperforming the QQQ index this year. It's a stealth bull market. Commodities are doing great. Gold's top performing asset. So what we're saying here is that this is part of the problem. This is part of the solution. This is a necessary, essential piece of portfolio. You could neglect it in the pre-2020 world because that was a world of disinflation. That was a world that didn't have extreme rapid innovation, didn't have reshoring, didn't have this huge tech build out. So this could have been considered an optional asset class in the old world. And what we're saying in the new world, that's certainly not the case. And if you don't have exposure to this, you're going to leave money on the table. So I'm going to wrap this up with a summary slide, and then I'm going to show you our asset allocation. And the asset allocation is just going to kind of bring home how do you prudently gain exposure to this stuff. Debt fueled disruption. So a wartime mentality is emerging. We are in a race for tech industrial dominance, and losing is becoming existential, and that's going to be more clear as we move forward. We're in a situation where we're clearly adopting a win at all cost mentality. That's a huge platform shift. Who's going to pick up the tab? It's going to be done through debasement. And as somebody that sits there and owns dollars, that should concern you. How do you know the dollar's broken? Because you're worse off by saving it. If you save $100 now, your purchasing power is likely going to be significantly less 1, 2, 3, 4, 5, 10 years from now. So owning assets with embedded scarcity protects you against the debasement. We strongly believe is an inevitability to pay for all that structural overspending that they told you didn't matter, which clearly do now, and the ambitions to the world that we're obviously moving to. So I'll leave you with this, and I really think this is an optimistic view, and then I'll show you the allocations. Innovation is the outlet and the opportunity. We're moving into a new paradigm. It's truly disruptive innovation. It's going to make lives better, longer. All good things are going to happen. It's going to get weird in the mid-time, so things are going to get a little disruptive. But if you play it right from a portfolio perspective, which is what we're talking about today, how do you capitalize on this? Lean into the 3 phases of the AI technology. I showed you phase 1, phase 2, phase 3, which was build, adopt, automate. Lean into the next stage. Own real assets because they're going to continue to benefit from what we believe will be a 10+ year CapEx cycle to get us to this new reality that we're moving towards. And then hedge based off the understanding that we can't pay this debt back without debasing. So if that's the setup, you need to own assets with scarcity. So finance by debasement, power by innovation, balance by diversification. And I said it before, I'm going to say it again before I give you the allocations. We're not going back to a regime where you don't have disruptive technology and debt and deficits don't matter, and you don't need to build out all this different infrastructure to support that. That's not happening. So don't get rooted in the world that you're accustomed to, because that world has long left us. We're 5 years into this right now. It's not stopping. So I'm going to show you what our asset allocation looks like. Now, I want you to gain exposure to all these themes that I spoke about. And that's on the right, but I want you to focus on the left. If you were a 60-40 investor and you had 60% in stocks, 40% in bonds, we're not throwing out the playbook entirely. All we're saying is diversify, own some gold. This is our neutral allocation. We're a bit overweight on these now, but I'd like to see people have at least 5% of gold bullion. A lot of people talk about gold, but few people own it in that size. We'd like to see that. We'd also like to see people have exposure to diversified real assets, commodities, natural resource equities, infrastructure development. All in right now, as we sit here, our total asset exposure to gold and diversified real assets is showing you 8 there because that's our neutral, but we're overweight these assets. It's actually closer to 11. And Bitcoin, if it's 0 for you, and you can open it, and you can have exposure to, excuse me, that means there's no structural limitations. It makes sense for you guys. That number is closer to 2 instead of 0. But if you can't own it, that's fine as well, as long as you own the gold and the real assets in a prudent dosage, which is what we're showing you right now. We think life is going to be good from an asset allocation perspective. So I threw a lot at you. Carl, what do you want to talk about?
So for Bitcoin, how you guys like to access it? Are you looking at it more in the indexing space? Are you looking to kind of mirror type strategies like a MicroStrategies or a BitMine? How do you guys think is most prudent for investors?
We do it through an ETF. So we have our own ETF, HODL. HODL it stands for hold on for dear life, because that came out during 2020. Instead of saying hold, one of these tech guys read HODL. And that caught on. So our ticker's HODL. But regardless of which ETF that you pick, we think that that's a totally reasonable way to gain exposure to your Bitcoin ETF. Excuse me, to your Bitcoin exposure.
Now, when you're talking about the ideas on the right side here, we talked about AI, we talked about robotics. How do you guys think about the allocation to those spaces? You have more like a traditional equity portfolio and use them as satellites, or you guys really, you know, a little more bullish to the point where we're having larger plays just directly to those themes? Because I think a lot of times that's the question I get from clients is, how should I think about including this in my overall portfolio?
Yeah, that's a good point. So we use what is generally considered a core satellite approach, is where we have the core exposures to the market, which you're seeing now. But then within our equities, we're strongly expressing a tech-oriented view. And we're doing that through the 3 phases of the AI cycle that we described there. So it's a lot of the candidates that you're going to expect. Exposure to companies like NVIDIA, companies like Microsoft, companies like Tesla. And now I just describe companies that are either providing the actual technology or companies that are benefiting from the technology. And we're constantly leaning into the phases. So if I were to break it down to numbers, if my equity allocation is 54%, I would like to see 20% of the total 54%. So close to half of my allocation towards technology and innovation.
Where do you, I think every other week we have people calling for a potential pullback. The market's high, valuations are high, historically. Where does this whole situation go wrong? And then, if the market does have a pullback, given that these are in the tech space, they could potentially have a little bit larger of a drawdown. How should somebody be thinking about that? Because that's all. Oftentimes it's just that, hey, I'm on the sidelines, I want to get in, but I look at the market today, should I be concerned?
That's the perfect question to ask. And the answer is yes, to a degree, but not really. So what am I saying? Keep the long game in your mind, meaning that AI, in our view, will over deliver and it will drive productivity. That productivity will drive growth. That's the long game. Now you've got to think of the here and now. And the here and now is we're moving from phase 1 to phase 2. Phase 1 was about who can spend more, and there's a lot of hype. You mentioned the word AI and you get $1 billion in your market cap. That's what that first stage was. Phase 2 is investors saying, hold on a second. They're sobering up a little bit. They're saying, you want to spend how many $1 billion on what? You're not being clear on how am I going to get paid back? That's when things get a little dicey. That's when you're going to start to see volatility. That volatility is actually a feature. That's the opportunity. Because what's that going to allow you to do? That's going to allow you to buy into dips and reallocate up. Because you're in a structural bull market with an innovative technology that's clearly here to stay, in our opinion, that volatility actually becomes your friend. So I wouldn't expect corrections significantly deeper than 20%, and I would buy the dips, assuming I'm not over-allocated going into them, which we never suggest people are. So if you're running a well-balanced, well-diversified portfolio, then you should fully embrace those volatility events with the idea that you should expect them. And it's actually a feature. Volatility becomes your friend because when people get panicky, they do things that otherwise are not in their best interest. And I'll give you an example of that. Bitcoin, as we sit here now, is down close to 30% this year. We've been buying because Bitcoin, we believe, is an early stage liquidity barometer. There's been signs of liquidity stress, not crisis, but signs of it, specifically in the repo market, because I don't want to go too far off track here, but basically what happened was that the United States is trying to control interest rates on the longer end of the curve because the 10-year is what prices debt. So if you're going to go out and get a mortgage or a car loan or et cetera, those rates dictate the rates to you. So when they're issuing so much debt to pay for this perpetual overspending, if they issue too much longer duration debt, what happens is yields start to increase. So what they did was they got really clever about 3 years ago and started issuing tons of short-term debt. And the issue with that is it's fine because it helped the longer end of the curve, but now that debt comes due and they've constantly got to roll it. So now they're rolling tons of debt also paying for the overspending. You put those two things together and you're ending up with liquidity pockets. And that's why you saw the repo market spike a bit. And that is being reflected in asset prices. And what do people sell the most when they get scared and they get nervous about the future? They go to Bitcoin. It's very volatile. It's not anchored to earnings. You can't value it. So they jump into the portfolio and say, I'm going to sell that because I'm a little bit nervous. So now you see a 30% correction. We're systematically and prudently in small dosages, I think of like a 0.5%, increasing our allocations to Bitcoin, understanding it may fall more, but we think that those buys will look really smart 12 months from now. And we think, unfortunately, technology is going to see a similar event sometime in the first half of 2026, where things get cheaper, people get scared because a lot of money's been spent. Not a lot of money is coming back in through vis-a-vis productivity. People are saying, hold on a second. How much am I spending and how am I getting it back? You get volatility, you get shakeouts. I smile and buy because I'm not overexposed going in.
Yeah, I think that's an interesting point. I mean, if you look at people talking about Bitcoin and the crypto space, earlier this year when it was at 115, 120, everyone wanted to get in. Now that it's pulled back to 80 or 90, the level of conversation around it outside the institutional side is not as much. Retail hasn't been jumping in, I think, and that's obviously historically the issue. And then you think about the hyperscalers like Google and Video, all these big companies. The big news, right, is Nvidia, like some of the big hedge funds and guys like Peter Thiel selling huge, or SoftBank selling huge stakes in Nvidia, and the market drops, not realizing they took that money and then reinvested it in other AI names. So I think it's a lot of folks we talk to get a little bit jittery when they see the big companies having some of that volatility. Obviously not realizing there's a lot of other opportunities outside of just seven companies in large tech.
Totally. Totally.
So for those on the call, I think the importance today is just highlighting there are a lot of other ways to access these type of strategies, and you don't have to be an expert. David and his team, specialize in these type of thematic investments, so you can get it under an index variety where they're going in there and they're picking the names, and you guys can sit back and say, we just like the space. I think there's a lot of value in considering certainly these specific areas in portfolio inclusion. Myself can be a resource to you guys as you guys evaluate whether this stuff makes sense for you personally and your overall investment strategy. We certainly can lean on the VanEck team as well. They have a wealth of resources. So for those of you guys on the call, realize you do have access to support when considering these type of investments. So with that, I'm going to go ahead and thank David. Amazing presentation. Greatly appreciate the information, and love to continue this conversation in the new year as we get some further updates.
Carl, thanks so much. It was a pleasure. Great conversation. Thank you very much.
All right, thanks everyone. Hope everyone has a wonderful rest of their day. Take care. Thank you.